So, what are people and smart investors that are expecting the market to absolutely go down the gutter wanting to do? They want to. Hey guys, it's been a crazy last few weeks in the markets. There has been an absolute whirlwind and a lot of tanking in the stock markets, in the equities markets, and specifically the Treasury, the bond market. The 10-year Treasury note yield has been, I think, at record lows. Every single day it's gone to a new record low every day, I think, of this past trading week. And I think right now it's sitting around 0.75, 0.74, something insanely crazy. And what I'm going to talk about in this video is how that actually correlates to mortgage interest rates, because I think there's a little bit of a disconnect between what really causes interest rates to go down, whether it's the Fed funds rate, which everybody hears is also going down, which was also cut, by the way, I think last week by 50 basis points. So half of a percentage point was the Fed funds target reduced by. And some people think, okay, well, that means mortgage interest rates are going down. And that's not really how things work. And there's a lot of people also that are making fun of people for thinking that just because because the Fed dropped the funds rate, that mortgage interest rates are going to go down. And the truth is, usually, many times when one happens, the other will happen as well, but it's not the cause and effect relationship that you might think it is. So I just wanted to address this real quick and kind of explain it, because I don't think it's a topic that's explained many times, and in case you're curious, I think it's worth a listen. So real quick, when we're talking about securities, we have different forms of government-backed securities that are particularly desirable in a time when everybody is fearful. For example, right now, why is everything tanking? Coronavirus. With the spread and uncertainty of this, nobody knows the actual implications of the virus and what effect it's going to have on the US markets, on the global markets in general. There's a lot of conservativeness, schools and businesses shutting down or having restricted hours, cutting their forecasts on production, because nobody really knows the implications of what's going to happen. And until we have a vaccine, we can really identify what the outcome is going to be. Then, of course, everybody's going to be a bit pessimistic. So what are people going to be expecting of global and national growth? Well, they're going to be perceiving that there's a good likelihood that the economy will shrink or possibly head to a recession, worst case scenario. Again, your opinion as to whether this is overinflated or not is besides the point right now. We're just talking about what people perceive this to be. So, what are people and smart investors that are expecting the market to absolutely go down the gutter wanting to do? They want to preserve their money. So there's a few different ways of doing that. The first one is US Treasuries. Now, you have different types of US Treasuries, and they primarily go on their different lengths of maturity. So for example, you have bills, which is 2 years and less. You have notes, which is between 2 and 10 years. So 2, 3, 5, 7, 10-year notes. And then you have the 30-year bond. But for the sake of this illustration, I'm just going to use the term bond for the entire group of treasuries, okay? And now primarily, you have the 10-year Treasury note, which is most directly correlated or at least referenced when we're talking about mortgage interest rates. And I'm going to explain the reason for that in a second. You also have the 30-year bond, which is a longer-term one. So typically speaking, if we look at the 10-year, that's more directly correlated to the 15-year mortgage interest rates, and the 30-year bond is a bit more closely tied to the 30-year fixed-rate mortgage. Now, what happens, again, when everybody's looking for high security places to put their money? Well, if they think that the market is going to be shrinking, or if they see the equities just shedding money every single day, large percentages in many cases, what they are actually anticipating is that they might actually be losing money. So what would you rather have than losing money? Well, you'd probably much rather have even a very, very conservative return guaranteed on your money rather than actually lowering your net worth. So not just buyers, not just individual buyers like you and me, but also major institutions and countries even. So Japan and China, they're some of the biggest investors in US securities. So when somebody buys a security from the government, that's essentially them owning a piece of debt. So when we say we have a lot of foreign national debt, that is illustrating that, for example, that China and Japan and these other countries are buying up a lot of our bonds because they look at it as a guaranteed secure investment. So the way bond prices work is they're essentially an auction. So it's kind of like a reverse auction if you think about the price, because the more demand there is for it, the lower the price goes. Or I'm sorry, the more demand there is for it, the lower the yield grows, the higher the price goes. If you're familiar with cap rates, it's a very similar concept. So the lower the cap rate that you're paying, that you're buying a property for, the much higher the price, and therefore the lower the yield you're actually going to be getting based on that face value dollar amount you paid. So in other words, the lower the yield, the lower the cash on cash return. So if you have a $10,000 bond, for example, that is at a 3% rate face value, and 2 weeks from now, there's a whole influx of buyers' demand looking for these very low yielding bonds just because they are of the opinion that the market's going to go to complete crap, and they want to make sure that their money is parked in a safe place so that for the next 10 years they have this standard minimum expected return on their money that they can plan on. Well, then that is actually going to drive that price down. So maybe now the holder of that $10,000 bond might say, okay, well, I have a lot of buyers here looking for this. Instead of selling this $10,000 bond for face value of $10,000, now maybe they can get a buyer for $11,000. And therefore, that still has the same $10,000 face value, but now that $11,000 paid cash amount brings the actual cash on cash return of that bond down. Okay, so it's essentially a reverse auction system. So the more demand there is, the lower the prices go. Now, what does this have to do with mortgage rates? First and foremost, mortgage rates are also a relatively secure long-term investment. However, they don't have the same security as the guarantee of the federal government. Okay, but what you have are packages of mortgages. Once loans are originated, once a lender takes, let's just say, 1,000 buyer applications and originates 1,000 loans for home mortgages, they're going to take that and they're going to package it up, and then they're going to sell it. And you have major buyers of mortgages such as Fannie Mae, Freddie Mac, and Ginnie Mae, which take these pre-packaged deals, buys it off the hands of these mortgage loan originators, and then they take these in turn and they package them as mortgage-backed securities, and they sell these securities backed by these mortgages, okay? So it's a little bit riskier just because it's not the same guarantee from the federal government as we have in Treasuries, but because they are still perceived as a much more conservative and long-term low-yield investment, they still do provide a lot of security or perceived security for a lot of big-term investors. But because of the higher risk, there is a yield premium, there is a risk premium. So instead of having the same, let's just say, like right now, the 10-year yield is at around, like I said, 0.75, then you're going to have usually a few points higher for mortgage rates or for mortgage-backed securities, because those are perceived to be slightly higher risk, but at the same time, they follow the same pattern. Because just like yields, when people are looking to dump money into a safe place, they're comparing different vessels for parking their money in. So while some are looking at mortgage-backed securities, some are going to be looking at treasuries and vice versa. So as treasuries go down, they're also comparing, and they're probably rushing into mortgage-backed securities as well. And as more money goes into mortgage-backed securities, the same thing happens. The price goes up, the yields come down, which drives mortgage rates down. The reason that drives mortgage rates down is because this is a free market. And as lenders have increased demand for their packages of loans, even though the rates are giving a lower return, they have two options. They can continue to originate loans at that slightly higher interest rate and collect maybe a slightly higher margin, but then what's the next lender down the road going to do? They're going to say, okay, well, tell you what, I'm okay with dropping my rates, my lower rates, and passing that savings on to the borrowers, and I will take the same spread I had before. And then the lender's like, okay, well, to stay competitive, we have to do the same. So they drop their entire thing as well. So it essentially drives mortgage rates down hand in hand with the demand for buying these mortgage-backed securities. So the mortgage-backed securities market is extremely important in how mortgage rates are actually go. But that's kind of tied hand in hand again with treasuries, because the more perceived uncertainty and fear there is in the market, these are the vessels that big investors are rushing to and putting their money on. So the more demand we have for those things in uncertain times, it drives the yields down, it drives the prices up, and therefore you as the borrower get to experience the benefit of having lower cost, cheaper money. Now, on the other hand, when we're talking about the federal funds rate or the nominal rate, this is not directly tied to mortgage rates because this is actually short-term debt, consumer debt, for example, credit cards, home equity lines of credit, and adjustable rate mortgages. These are the places where you're actually going to see the benefits of having a lower Fed funds rate. And the reason for that is the federal funds rate is essentially the rate that banks borrow money from each other for. And it's also called the overnight rate. So if a bank is going to make a loan, we have what's called a fractional reserve banking system in the United States, okay? So in the United States, in order for most financial institutions above a certain net worth amount, they have a 10% fractional reserve requirement, which means that if they have a deposit of $100,000 into their bank account, they can set aside $10,000 of that amount, and then they can originate a new loan for $90,000. So it's like a 9-to-1 ratio. So they can loan out $90,000, only maintain $10,000 in their bank account, and then you can also imagine, let's just say they give that loan to somebody else, and then that buyer gets that loan, then maybe they go buy a piece of real estate with that, and then the recipient of that money, the seller of that piece of real estate, they can then go in turn and take that money, put it in their bank account, and then that lender can say, okay, we got a $90,000 deposit, set aside 10%, and then originate a loan for around $80,000. And you can see how that perpetuates down in a consistent cycle. Anyway, that is how our banking system works. So when we have a lower Fed funds rate and banks are able to borrow money much more quickly and say, hey, I'm actually going to be able to increase my reserve amount here for this lower rate, which means I'm going to be able to allow more consumer debt. I'm going to be able to originate more loans. I'm going to be able to offer more lines of credit for a lower amount. This stimulates lending and it drops the price of money, which also stimulates consumerism, right? So buyers are able to go out and more confidently take out a loan for their business or put some more things on their credit card because they feel that they are getting a better rate on their money, okay? So that's the difference between the federal funds rate and the Treasuries bond market, and the difference between how one is impacting the other. Again, HELOCs, like short-term interest rates, adjustable rate mortgages, those will be benefiting from the lower Fed funds rate. And in turn, the lower Treasury yield is going to be benefiting the mortgage market. Now, many times the Fed fund will drop, the Federal Reserve will decide to drop the Fed funds rate for the same sort of reasons that people will be flocking to securities such as Treasuries and mortgage-backed securities. And that is because usually there's a bit of uncertainty and fear as to a slowing market or uncertainty in the market. And because of that, the Fed fund usually drops their rate so they can instigate more consumerism and borrowing and lending and more liquidity in the marketplace. And at the same time, that's also when usually people in general, investors, are going to be putting their money in places like Treasuries and mortgage-backed securities because they're also fearful that the economy might not be doing as well as they think or they want. Therefore, they drive the yields of these securities down. So anyway, I just wanted to clear that up for you. Hopefully it's not too technical. Hopefully it's helpful. And anyway, if you haven't already, be sure to subscribe to our YouTube channel for other videos like this and our monthly San Diego County real estate market update. If you found value in this, I'd appreciate it if you hit the like button and share it. And as always, thank you for watching, and we'll see you in the next video.